Now I'm going to go through 3 important tips to remember for operating as an S Corp. Tip number 1, perhaps the most important thing to remember, is the requirement to pay yourself a reasonable compensation. This means that you actually put yourself on payroll and you get a W-2 from your company. So the S Corp isn't totally a free ride because the IRS will get some payroll tax, the Social Security and Medicare, through your W-2 salary. But everything left over after that is not subject to self-employment tax. So how much do you pay yourself? The IRS doesn't give specifics, but rather general guidelines. It used to be more common for CPAs to say pay yourself a certain percentage, like 60% of your profits as a salary or 50%, but it really depends on what's common in your industry. If you want to be aggressive, you could ask yourself, what's the least I could pay someone else to do my job? Is it minimum wage? Because the less you pay yourself often means more tax savings. The reason for this is because the profit left over after you pay yourself is the amount that's not subject to self-employment tax. So if your earnings before paying yourself is $100,000, let's say, and you take a W-2 salary of $30,000, that leaves you a profit of $70,000. The 15% self-employment tax savings on that $70,000 is over $10,000. So the higher the profit, the higher the savings. You just don't want your salary to be so low that the IRS notices and comes and says that you're paying yourself way too little for the work you're doing. And then in theory, they can charge you for the payroll taxes you would have been paying had you been paying yourself a more reasonable salary.